Welcome back to the Daily Crypto Roundup. It's Sunday, October 26th, 2025, and the crypto markets are reminding the world why this space never stays down for long. After last week's historic liquidation wipeout, Bitcoin has bounced sharply back above $113,000. Ethereum's Vitalik Buterin has issued a rare and surprisingly philosophical warning about validator security that's stirring debate across the entire ecosystem. XRP is surging again, closing in on $2.60, as talk of an XRP exchange-traded fund gains credibility, and a new CFTC chair publicly signals support for Ripple's approach to regulation. And on the geopolitical stage, the BRICS alliance is accelerating its move away from the dollar, with new oil deals denominated in local currencies instead of greenbacks. 4 stories, 1 theme. Power is shifting, both in markets and in money itself. Before we jump in, take a moment to follow the podcast and leave us a 5-star rating. It helps new listeners discover the show, helps us keep the lights on, and lets me keep digging into these stories with zero corporate filter. If you're already part of our regular audience, thank you. Every single rating pushes this movement forward. All right, let's start the day where we always do, with the top 10 coins and the heartbeat of the market. Bitcoin holds the throne, sitting just above $113,000, up roughly 2% in the past 24 hours, and now a solid 7% rebound from last week's lows. It's the clearest sign yet that the market has absorbed the shock of that massive liquidation and is regaining its footing. Ethereum follows at around $4,050, holding firm after a choppy week that saw it briefly dip below $3,900 before buyers stepped in. Solana continues to outperform most of the market, trading near 184, up more than 4% in the past day, with network activity still rivaling Visa in daily throughput. XRP sits just under $2.60, riding a wave of ETF speculation and renewed optimism around Ripple's standing with regulators. Cardano trades around 68 cents, up nearly 4% on the day, showing quiet but steady accumulation from long-term holders. Dogecoin is changing hands at 22 cents, still one of the most reactive coins whenever retail sentiment ticks back toward bullish. Avalanche sits near $65, modestly green on the day. Toncoin holds at about $7.12 as Telegram's ecosystem keeps expanding its crypto use cases. Chainlink trades around $21.20, while Stellar Lumens rounds out the list near 39 cents, both showing solid network engagement and consistent mid-cap interest. Altogether, those 10 assets account for nearly 3/4 of the total crypto market cap, which now sits around $3.8 trillion. Bitcoin dominance remains steady at 57%, signaling that liquidity continues to favor the majors before filtering down to the rest of the market. A classic hallmark of an early bull phase rebuild. Now let's get into the stories that define that foundation. Only crypto can deliver this kind of drama. A record liquidation, panic headlines, and within 10 days, a full rebound that defies every bearish forecast. Earlier this month, the market witnessed nearly $19 billion in leveraged positions wiped out in less than 24 hours. Exchanges struggled to keep up as cascading liquidations triggered one of the fastest drawdowns since the Luna collapse. Bitcoin plunged from its record highs above 125,000 to lows near 104,000, wiping hundreds of billions from total market cap overnight. But here's what most people missed. While retail traders panicked, institutional wallets were quietly accumulating. On-chain data from multiple analytics firms showed a sharp rise in addresses holding more than 100 Bitcoin during the sell-off. In plain language, that means the big players bought the dip. Fast forward to this week, and the strategy looks obvious. Bitcoin bounced, retested the 110,000 region, and held. Futures open interest normalized. Funding rates cooled off. The speculative froth got cleared out, and the foundation looks stronger than it did before the crash. Right now, the focus shifts to resistance between 115 and 120,000. Analysts from several trading desks argue that if Bitcoin breaks and holds above that zone, momentum could carry it toward 140,000 before year-end. The reason? Supply-side constraints. Long-term holders, the so-called diamond hands, now control over 70% of total Bitcoin supply, according to Glassnode. That's the highest share since early 2021. With fewer coins available for sale and institutional inflows still increasing, the path of least resistance remains upward. Of course, corrections are never off the table. The crash proved that even strong hands can get caught in leverage traps. But the psychological damage seems limited this time. The mood across trading communities has shifted from fear to cautious optimism. Bitcoin's comeback isn't just about price, it's about confidence. It's proof that even after the biggest flush out in years, belief in this asset's long-term role as digital gold hasn't wavered. When Vitalik Buterin speaks, the market listens. And this week, he didn't mince words. In a new post, the Ethereum co-founder warned that the network could face hidden risks if validators, the entities responsible for securing and verifying the blockchain, become too dependent on off-chain trust systems or external coordination. His message was subtle, but serious. Decentralization isn't something you achieve once and forget about. It's something you have to actively protect. Vitalik raised concerns that large staking providers and pooled services might gradually consolidate control, creating a potential single point of failure. If a handful of entities dominate validator operations, Ethereum could slip into the same centralization trap that plagues traditional finance. The market reaction was muted. Ethereum's price barely moved, but the philosophical weight landed. Ethereum has always tried to balance efficiency with independence. It's why Layer 2 networks like Arbitrum, Base, and Optimism exist, to scale without sacrificing security. Vitalik's post wasn't a panic button. It was a preemptive reminder. He's essentially saying, if Ethereum is going to power the world's decentralized economy, it can't start acting like a bank. In technical circles, the debate that followed was healthy. Developers proposed new monitoring tools for validator diversity. Others pushed for better incentives for smaller validators to compete with big staking pools. The point is, Ethereum's ecosystem is self-correcting. It has the brainpower and the transparency to address vulnerabilities before they become existential threats. From an investor's perspective, the real takeaway isn't fear, it's reassurance. When the founder of a trillion-dollar network is publicly flagging risks before they bite, that's what long-term sustainability looks like. Meanwhile, Ethereum's fundamentals are solid. Daily active addresses are back above 1 million. Layer 2 scaling continues to grow. And institutional use cases, from tokenized treasuries to stablecoin settlements, are expanding faster than most people realize. For traders, 4,000 remains the pivot level to watch. Above it, Ethereum has breathing room. Below it, expect range-bound volatility. But structurally, Ethereum's value proposition hasn't changed one bit. It's still the operating system of decentralized finance. Now, it's been a long time since XRP has had momentum like this. The token that once symbolized both promise and controversy is finally finding alignment, with markets, institutions, and maybe even regulators. Over the last week, XRP climbed more than 20%, breaking through 250 and approaching the critical 260 mark. Trading volume has doubled across major exchanges, and technical analysts see a clear breakout pattern forming. An inverse head and shoulders setup that could project toward $2.80 or even $3 if it completes. But what's fueling this? Part of it is simple rotation, investors moving from Bitcoin profits into undervalued majors. Part of it, though, is rumor, and the kind of rumor that moves markets. Multiple industry insiders have suggested that an XRP-linked ETF product is being quietly structured behind the scenes, following the successful launches of Bitcoin and Ethereum funds earlier this year. While no formal filing has hit the SEC's database, the chatter alone has sparked speculative demand. Then there's the regulatory twist. The newly appointed chair of the Commodity Futures Trading Commission has expressed public support for Ripple's approach to compliance and real-world settlements. That may sound bureaucratic, but in this space, tone matters as much as law. For years, Ripple battled against the perception that US regulators would never warm to its model. Now, for the first time, it has an ally in one of the most powerful financial agencies in the country. Institutional players have taken notice. Several on-chain analytics firms report an uptick in large XRP transactions, what analysts call whale moves. This suggests big money is positioning ahead of potential catalysts. And make no mistake, if an XRP ETF were to materialize, it would be a paradigm shift. It would mark the first time a crypto asset designed primarily for settlement, not speculation, received mainstream investment vehicle status. Of course, hype cuts both ways. The market has seen false alarms before. But even without an ETF, the fundamentals behind XRP's ecosystem look better than they have in years. Ripple continues expanding cross-border payment corridors across Asia and the Middle East. Several regional banks are piloting XRP-based liquidity solutions. And as de-dollarization accelerates globally, assets built for settlement speed and neutrality suddenly look a lot more useful. If you've followed XRP's story since the early days, this feels like vindication. After years of lawsuits, delistings, and doubt, XRP is finally trading on fundamentals again. While crypto traders obsess over price charts, the biggest shift of all might be happening far above the blockchain, in the architecture of global money. This week, another major oil deal was finalized between China and Saudi Arabia, settled entirely in yuan. Russia and India are conducting record-level trade in local currencies. Brazil has floated the idea of a South American clearing unit independent of the dollar. Individually, these moves sound small. Collectively, they signal something massive: the unraveling of the dollar's post-World War II dominance. For 80 years, the greenback has been the default language of global trade. But the combination of US debt levels, political gridlock, and weaponized sanctions has pushed emerging economies to seek alternatives. And the BRICS bloc, which now represents over half of global GDP on a purchasing power basis, is leading that charge. Why does this matter to crypto? Because every time the dollar's monopoly weakens, the demand for neutral settlement assets strengthens. Bitcoin was born out of this very dynamic, a response to trust erosion in centralized financial systems. Today, that erosion isn't theoretical. It's playing out in slow motion. Central banks are responding by hoarding gold, diversifying reserves, and, quietly, studying blockchain settlement layers. China's e-yuan pilot is already live in multiple provinces. Russia is testing cross-border settlements via the digital ruble. Even the European Central Bank is pushing ahead with its digital euro project. The race is on to digitize money itself, not to innovate, but to maintain control. And that's where crypto becomes the counter-narrative. While governments digitize control, crypto digitizes freedom. The overlap between those two forces is where the future of finance is being forged. We're entering an age where every nation wants programmable money, and every citizen wants permissionless money. That tension, control versus autonomy, will define the next decade. For investors, the takeaway is straightforward. Geopolitics and crypto are no longer separate worlds. They're merging. When oil trades in yuan and bonds yield less than inflation, capital looks for neutral ground. And increasingly, that neutral ground looks like Bitcoin. That's why each BRICS headline, each non-dollar trade, and each central bank digital currency pilot ultimately adds fuel to the same fire: the global hunger for trustless value. Pulling all of this together, here's the big picture. Crypto isn't just recovering from a crash, it's evolving through it. Bitcoin's rebound proves the resilience of decentralized scarcity. Ethereum's internal debates show a maturing ecosystem willing to confront its flaws. XRP's resurgence demonstrates that regulatory alignment is finally catching up to innovation. And the BRICS story reminds us that the entire monetary order is shifting under our feet. If you zoom out, it feels like the same cycle we've seen every 100 years in history: the currency reset. But this time, it's happening digitally, globally, and transparently. The lesson? Don't underestimate the quiet part of a revolution. It rarely announces itself with explosions. It builds slowly, through policy changes, through technology adoption, through millions of individual choices to opt into something better. That's what's happening now. Bitcoin above 100,000 isn't just a number, it's a signal that the free market alternative to fiat is no longer fringe. Ethereum's upgrades aren't just software updates, they're steps toward an internet of ownership. And every new digital currency launched by a government only validates crypto's original premise: that money should serve people, not power. For now, the market remains cautiously optimistic. Volatility will stay with us. It always does. But if you're holding long-term, if you're dollar-cost averaging into strength, and if you're securing your assets properly, you're on the right side of history. Speaking of security, a quick word from our sponsor. In a world shifting from paper to code, Control is everything. Ledger gives you that control. It's the safest way to store your Bitcoin, Ethereum, or any other digital asset offline, out of reach from hackers, exchanges, or regulators. Link is in the description. As we wrap up today's show, remember this. Every financial empire has believed its currency would last forever. Every single one eventually learns it doesn't. The question isn't whether change is coming. It's whether you're positioned for it. Crypto isn't a rebellion anymore. It's the next system forming in real time. And if you're listening to this show, you're already ahead of the curve. Drop your thoughts in the comments, follow the podcast, leave that 5-star rating, and as always, we will see you at the top.